fundsupermart.com.
Hello everyone. What's the best plan for investors in view of the recent Chinese economic slowdown? Today we have Jiang Yiqian, portfolio manager from the Harvest Global Investmests, to share with us her investment strategy for China shares in the second half of the year. Yiqian, thanks for joining us. In the second quarter, China's GDP growth slowed down again. That's the year-on-year growth is 7.5% only. What's the outlook for China going into the second half of the year? And what sectors provide the most attractive opportunities?
Without any new stimulus from the government, we expect economic growth to slow down further in the second half of this year. If we assume third quarter and fourth quarter to maintain the same sequential Q-on-Q growth as second quarter of this year, which is around 1.6%, we will have GDP growth of only around 7.1% in the second half of the year. Recently, Premier Li Keqiang stressed government's intention to achieve a target GDP growth of no less than 7.5% for this year, which means there need to be extra push from the government to boost growth in the second half of the year, mainly from fixed asset investment on certain industries that fitting the structural reform, such as railway, alternative energy, urbanization. In order to achieve the 7.5% growth target, we should expect a growth of around 7.4% in the second half of this year, which means an accelerated sequential Q-on-Q growth of around 1.8% in the third quarter and around 2.1% in the fourth quarter. So although the government indicated that it was not likely to implement any aggressive stimulus unless the economy slowed much more than expected, the policy direction for the second half of the year is definitely more positive compared to the first half of the year. Because in the first half of the year, the new government focused more on structural reform at the expense of growth. Going forward, we expect the government will adopt a more balanced approach to make sure reforms are carried out gradually without derailing the healthy economic growth. With this improved macro outlook, we expect sectors that benefit from government's policy will do well in the second half of the year, including infrastructure-related construction or equipment companies, construction materials, environmental protection-related plays such as clean energy, water treatment, etc. We also prefer property and brokerage in the financial sector for their stronger earnings outlook compared to banks and insurance companies. Meantime, we continue to like investment themes with sustainable long-term growth, such as healthcare, internet, oil service, auto, baby products, etc. These are growth areas that rely less on macro policy, which are expected to provide good alpha to our portfolio.
As the central government combats shadow banking, what's the implication to the Chinese economy and investors?
The Chinese government implemented new rules on wealth management products. However, we believe that these measures will be carried out gradually in order to have limited impact on system-wide credit supply as well as on real economic activities. We believe these new regulations will eventually help to strengthen investor confidence in China's financial system. It is estimated that the size of China's shadow banking could be around 15 to 25 trillion renminbi. We do see risks in both the commercial banking sector and non-bank financial institutions. And we believe during the process of restructuring these debts, we may see some defaults which may lead to market volatility. However, we do not believe banks' wealth management products as a whole would have very high systemic risk, or like the subprime debt or CDO. This is mainly because there is sufficient liquidity in China's financial system. For example, we have 3.5 trillion US dollar forex reserve, and also 20% required reserve ratio at banks. So there is still room for the PBOC to ease liquidity to avoid a significant credit crunch. As long as China can still maintain relatively high growth in the coming years, the shadow banking can be gradually restructured with risks better monitored and regulated. It is reassuring to see that Premier Li stressed the importance of maintaining a floor growth rate of around 7% per annum from 2013 to 2020.
From a valuations viewpoint, is it still a good time to invest now?
MSCI China is currently trading at the bottom of historical range at around 8.8 times 2013 PE and 8.1 times 2014 PE, with expected EPS growth of around 8 to 10% per annum. We believe market sentiment has been extremely bearish on China, and a lot of concerns on slower growth as well as risks in the financial system have largely been priced in. In the near term, we may see market volatility as economic data are likely to remain relatively weak in the next 1 to 2 months, and the ongoing reform may still cause some pain in the market. However, when sequential economic growth starts to pick up gradually in the rest of the year, we expect China shares to deliver better performance. With 1 year or longer investment horizon, we believe current levels offer very good risk-reward and would advise investors to accumulate China shares on any market weakness.